Hi, Tom Lydon here in Chicago at the Morningstar ETF Conference. I'm here with Dan Draper, who's Global Head of ETFs at PowerShares. Great to see you, Dan.
Great to see you, Tom.
A lot's been going on in the space, but advisors, although they continue to throw money into ETFs, somewhat concerned about the potential of volatility. So let's talk about volatility for a minute.
Yeah, no, obviously we're in a very elongated bull market, one of the longest, I think, in multiple generations, which is the good news. But then you do see a lot of uncertainty. There's a lot of anxiety around valuation levels. Now we have geopolitical events like North Korea. So you are seeing really small spurts of volatility. And I think that's where we've had very good success around low volatility equity products, specifically SPLV, our S&P 500 low vol. And you can really see that, looking at, say, the 10-year Treasury, where we had more expectations of, after the Trump election, of economic growth, rising rates, 10-year going up to over 2.6%. Today, it's down to 2.06%. So you really see kind of the whipsaw and expectations of volatility, and you see a lot of investors coming back to this core strategy of low volatility. And SPLV continues to perform well, providing some of the equity upside, but also cushioning some of this downside.
So let's talk a little bit about that index. We don't have to get into specifics, but how it's structured. How does it provide for less volatility? You take the S&P 500 from a cap-weighted standpoint. What are some of the tenets and how is that a little different?
Yeah, if you think about traditional market cap weighted, quote unquote, the market, there is inherently a little bit of a momentum bias because the largest, most popular companies, as reflected by their share price times shares outstanding, that's really what you're getting, and it is the market. But I think being able to look back to many clients, and especially a lot of FAs covering their clients, they're looking for a different profile. I want market exposure, but at the same time, if I'm trying to meet a retirement goal or I want to generate additional income for some other purpose, right now with rates so low, I'm almost by default pushed into equities, but I want to be able to sleep at night. So how can I get this exposure to these great S&P 500 companies, but at the same time make sure that there is a little better risk-reward benefit, especially on the downside. And so by deconstructing the market cap weighted and screening first by the companies with the lowest volatility, which is what the index does, and then you reweight with the most volatile or the least volatile with the highest weighting down. So that gives you that combination of not only a screening of low volatility stocks, but also it's the weighting within the index itself, which also favors the low volatile. So you get a nice profile.
And putting that in an index and having this systematized process behind that really adds that comfort. So as we continue to see these types of opportunities, investors can proceed with confidence because what the worst thing that they can do is not put the money in, and the market continues to advance in the next couple of years, right?
Because what's interesting too is you think about that strategy that for many investors who have maybe a market cap weighted, say a balanced portfolio, and they combine it with their fixed income. What's ironic is by taking low volatility equities, you can actually in some cases increase your equity exposure, right? Versus, and that helps purchasing power, income in some cases, but then actually still have the overall risk profile you would have through traditional balanced market cap weighted. So it's really interesting.
And finally, you folks are one of the pioneers in smart beta strategies, but it's been really tough to beat the S&P 500 cap weighted strategies. Once we see the volatility increase, and it will at some point in time, you got a pretty good lineup where you're ready to tackle it from all different areas.
Yeah, I think what you're referring to is, you can pick some metric, but let's pick maybe the 10-year Treasury as a risk-free metric. Once maybe the 10-year Treasury gets to, who knows, 3.5%, 4%, 5%, more normalized monetary conditions, you would expect these other risk premium to mean revert. So you get more quote-unquote normal market conditions. That will be better for some active managers, but as you said, also for smart beta. Being able to have different tilts around quality, low volatility, as well as the traditional style indexes, all of that can really help you diversify better and ultimately meet those future wealth goals.
Yeah, great things to talk about with clients. Dan, as always, great seeing you.
Thank you, Tom. Great to see you.